Welcome. In this episode, we will discuss what is happening in the U.S. stock market, recent market movements, and developments in several major companies. Please note that the information presented here reflects opinions and market analysis for educational purposes only. It is not investment advice. You should always conduct your own research and make decisions based on your financial situation, risk tolerance, and future expectations. The U.S. market opened with a significant drop. The Dow Jones fell by 2.19%, the Nasdaq declined by about 2%, and the S&P 500 also moved lower shortly after the open. Bitcoin declined as well. This broad weakness appears to be driven primarily by a sharp rise in oil prices. Oil prices increased by 8% today. Yesterday, oil had surged as much as 13% before pulling back to around 3% by the market close. Today, it moved back up by 8%. The main reason behind this volatility is the ongoing war in Iran. The conflict was expected to end over the weekend, but it did not, raising concerns that it may last longer than just a week. As geopolitical uncertainty increases, markets tend to react negatively in the short term. Looking at historical parallels, the Russia-Ukraine war created even greater concerns, particularly because Russia plays a more significant role in global oil supply and European energy demand. Despite that, the market experienced a correction and eventually rebounded while the war was still ongoing. In a similar way, if the Iran conflict continues, it could lead to a correction that some may classify as a bear market in the short term. However, from a long-term perspective, this is unlikely to be catastrophic. In the short term, a bear market is possible. However, such phases often create attractive entry opportunities. Market pullbacks of this magnitude typically occur once every 2 or 3 years. They are not frequent, and they tend to reward disciplined investors who prepare in advance by building watch lists, evaluating valuations, and identifying strong companies with solid fundamentals. Now, looking at individual companies, several large-cap stocks were accumulated recently in equal allocations of $200 each: Visa, Nvidia, Meta, Amazon, and Microsoft, totaling $1,000. The focus was exclusively on large-cap companies, as small caps had already moved up slightly. Visa was already in negative territory, which made it attractive from a valuation standpoint. Nvidia reported strong results, and next year appears promising, yet the stock did not react significantly to the upside. Meta remains down relative to the Nasdaq, and the same applies to Amazon and Microsoft. There appears to be a divergence between certain large caps and the broader Nasdaq performance, which may suggest a relative valuation opportunity within these names. Additionally, Netflix was sold with approximately a 5% profit and replaced with ServiceNow. The sale was not based on concerns about Netflix's business quality, but rather on portfolio positioning and reallocation considerations. ServiceNow offers exposure to enterprise software and workflow automation, which remains a strong structural growth theme within the U.S. market. From a broader strategic perspective, in the U.S. market, portfolio construction often begins with either ETFs or large-cap companies. ETFs may be more suitable when the market is trending higher, while large-cap quality companies can present attractive opportunities during market pullbacks. At current levels, Microsoft, Amazon, and Meta stand out as strong companies to consider based on their positioning, fundamentals, and relative performance compared to the Nasdaq. To stay informed about the latest developments in the U.S. stock market and in-depth company analysis, make sure to subscribe to the channel so you don't miss any future updates.